In May 2026, FIIs pulled out a massive nearly 59,000 crores from Indian markets. However, DIIs invested a massive 85,000 crores in the same month. So the question is, what are they seeing that foreign investors aren't? So who are these DIIs? They are mutual fund companies, pension managers, banks, and financial institutions. In this video, we'll discuss about which stocks were they buying the most, how much, and most importantly, why. Hi, I am Shrikant. I am going to walk you through the top 9 stocks that DIIs bought the heaviest in May. For each one, we look at the story behind the company, what's going right, what could go wrong, and what it means for you as an investor. We got 2 large caps, 3 mid caps, and 4 small caps. So let's jump right in. The first thing you would notice is that almost half of them are banks. So why are investors investing here? The answer is quite simple. See guys, if a country economy needs to grow, banks should also grow. Since India is the fastest growing economy in the world, so DIIs are investing in India's economic growth. The first stock is ICICI Banks. DII's biggest buy was ICICI Bank at 9,900 crores, and it's easy to see why. It's one of the best run private banks in India, combining strong loan growth and one of the cleanest balance sheets in the industry. Its NPA is just 0.33%, profits continue to grow, and despite trading around 2.7 times its book value, institutions clearly believe the quality justifies the premium. Coming to the risks, if the global economy slows down or uncertainty rises, loan growth could stagnate and NPA might appear. It's not a big issue right now, but worth watching. Next up, we have HDFC Bank. DIIs bought over 7,500 crore worth in May. HDFC Bank continues to dominate because of its massive franchise, adding 30 million customers in just 4 years. Deposits grew 14.4%, advances to 29.6 lakh crore. Asset quality remains strong with gross NPA at 1.15%. Risk, again the same geopolitical issues, could dampen credit demand. Top 3, we have Central Bank of India. Central Bank of India is a turnaround story. After years of struggle with bad loans, the bank has cleared up its balance sheet and is now growing again. Since it's still trading below book value, investors may be betting the market hasn't fully recognized the improvement. Coming to the risks, margins and operating costs still need improvement. Stock 4, we have Bandhan Bank. This is the highest risk stock among all these stocks. Bandhan Bank is in the middle of a meaningful transformation, reducing dependence on microfinance and growing secured lending. Asset quality is improving and collections are back to healthy levels. Risk, still some exposure to microfinance, which can be sensitive to rural stress. Next 4 stocks are from the energy sector. Investors are betting that India's energy demand will explode in the next decade. Stock 5, we have JSW Energy. DIIs brought around 4.06 crore shares. India is adding solar and wind fast. JSW is actively investing in storage. They currently have 13.45 gigawatts capacity, and by 2030 they are targeting 40 gigawatts. FY26 was excellent. Revenue up by 57%, solid EBITDA and cash profits. Risk, massive capex of 1.3 lakh crore by 2030. Execution, cost control, and actual power demand growth will be key. We have Premier Energies. It is another clean energy company, but focused on manufacturing. It is one of the biggest beneficiary of India's push to manufacture solar equipment domestically. DIIs have invested over 1,500 crores. Revenue has more than doubled in 2 years to 8,000 crores with strong profit growth. They have significant module and cell capacity, making them one of India's largest integrated solar players. Healthy order book, excellent ROE, and controlled debt. The risk is they have big expansion plans, so execution will be critical. Have Gujarat Energy. It saw DIIs put in nearly 4,000 crores. Strong government backing, massive infrastructure, and a quiet but steady shift to pipe natural gas in homes. The risks fluctuating global LNG prices, customer switching fuels, and regulatory changes. Indraprastha Gas. It has a solid CNG and pipe gas business with recurring volumes. The risk, global energy prices, and whether CNG stays meaningfully cheaper than petrol. One is a digital payments partner. Their digital payments will continue growing. The stock is Pine Labs. Pine Labs is a direct bet on India's digital payments move. They power payments, EMIs, and loyalty programs at 20 lakh merchant locations, processing huge volumes, very high switching costs, accelerating growth, strong margins, and big contracts in fuel retail. The risk, very high valuation. Growth has to keep delivering. The biggest takeaway isn't that you should blindly copy DIIs, it's that they're making certain bets on three themes: India's banking sector, energy transition, and digital payments. Whether you agree or not, understanding where investors are investing money is can help you generate ideas for your own research. Thank you.